Hello everybody, with you Andrew. In this video we will talk about entering into an agreement, how to enter a deal on younger time frames by type, 1 minute, 3 minutes, 5 minutes, and how to enter on older time frames. And I will also tell you the pros and cons of each method. In general, what do I mean by entering into an agreement? This is a combination of factors that must be on the chart to open any position. The entry can be aggressive, which has no evidence, or can be conservative, which has evidence to enter the position. In this video, there will be no talk about aggressive input, as most of you do not have enough experience and self-discipline to use it correctly. Now, a little theory. Before we start, for those who don't know what a structural hack is, on the screen you can see the breakdown of the structure and what it looks like in bull and bear markets. The bullish structure changes when the price updates the higher low for the uptrend, thereby forming a lower low, after which the uptrend begins. The same works with a downward trend. And now, for a better understanding, here's how it looks on the graph. You have to understand that there is a lot of information on the younger time frames. Reading market structure is very different from reading the market on older time frames. Obviously, there are many similarities, but there are also many nuances that differ. To effectively understand the structure of the market, let's say on the minute time frame, you need a lot of practice and even more practice on history. In general, I hope that you have understood at least a little. If not, then you will understand everything now. We currently have an open broadcast schedule. First of all, we look at the older time frames for macro analysis. We start with the daily time frame. Here, you can see that the price has renewed the old high and cannot hold on to it. This high acts as a pool of liquidity. After gathering the tables of traders, there was an expected reaction. We can expect a reversal in this range, and the price will start to move lower or start to move sideways. Now we switch to a 4-hour time frame. Here we allocate the first support zone and label it as a POI, which translates as a zone of interest. If the price goes lower and breaks through this area, then we will expect a lower high and enter from this area into shorts. But this has not happened yet, so we are still working on longs. Also above, we see the price value gap, which I marked with a red line. It serves as a price magnet, and with a high probability we will see the price there before the correction. On the time frame, we can distinguish the first zone of resistance. We will fix here 50% of the position. Already at this stage, we have a plan of entry, partial fixation, and full exit from the position. It's okay if the price goes below our interest zone. We will use the noted bearish order block to enter a short position. Now you ask, why was all this necessary? Everything is simple. We are now switching to a younger time frame, for example, a 5-minute chart, and we will look for entering a long position when the price is in our interest zone. And what does it give us? This makes it possible to enter a position with a short stop to increase the potential of the position, even tens of times. If we simply enter with a limit order in this area, then we will set a conservative stop at the minimum of the bullish order block that we noted on the 4-hour time frame. Currently, the potential of the deal is very good, 1 to 6, but we will try to increase it. Okay, now we wait for our price in the zone of interest, and only then we move to the younger time frame. Boom! We see the reaction, and now the matter is as follows. We need to isolate the lower high, where there will be a break in the structure, and after renewing the exact maximum, look for an entry point. As long as the price is here, I assign a lower high, it will be a structural element. When the price goes above it, then we think that the price will go up to our areas. Okay, I don't really like looking at structural elements like that, since there was one candle here, and after the world of liquidity. Let's try. We mark the lower high and wait for the price to renew it. This is what a structural break looks like. After it, you can find the entrance by various factors. We place a stop for the formed order block, a take on older time frames. The main goal is 2500. And now let's compare inputs on different time frames. The deal on older time frames was opened just from the support zone without waiting for confirmation on younger time frames. This deal could be entered with standard risk, the risk you agree to. For me, it is 1% of the deposit. The ratio of risk and profit is 1 to 6. By risking 1%, we can earn 6. The second deal that was formed after the local hacking of the structure has a ratio of 1 to 14. Here I analyzed another deal, but I decided not to show it to you. The risk-reward ratio on it was 1 to 29, but don't lose your head. You need to understand the essence of the market. and learn to at least work out the ratio of 1 to 3.